Welcome to Bloomberg Law on Demand. I'm Lee Pacchia. Joining us today is Lori Hoberman. She is a partner at the law firm Chadbourne Parke here in New York City, and she is the chair there of the Emerging Companies and Venture Capital practice. Her practice emphasizes venture capital, private equity, and general corporate counseling. Lori, thanks so much for coming in. Welcome.
Thanks, Lee. It's so nice to be here.
So we've been talking about M&A on this program a lot lately, and the general consensus has been that the trend line for deal flow is on the up and up, albeit it's being viewed with a sense of caution at the same time. Where is the state of play for venture capital?
Also very positive, on the up. And what we've seen since 2009, going into 2010, huge upswing. Third quarter of 2010, lots of deals going on. Fourth quarter of 2010, same trend. And I expect to see that continuing into the first quarter of 2011.
Weird stat coming out today in the New York Times. For 2010, the amount of investment was up, I think, something like 14%, but the overall aggregate number of deals is down. Anything to be made by that stat, or do you think it's just an aberration? It
could be that some of that represents maybe the funds coming in a bit later in the companies. So later stage investments may be less focused on the early stage. And I think one of the trends we saw in 2010 was less investments into those early stage companies, although that seems to be changing also with some funds that you would typically think of as much later stage investing funds coming in at the very early stages to reserve a place at the table for the later rounds.
You were recently at an event on venture capital, and the question was posed, if you want to be in venture capital, what sector do you play in? Did the entire audience just scream collectively technology? I mean, I'm always wondering, have the two terms, I mean, they seem to almost merge in the media. Is venture capital really all about tech companies, or is there...
It mainly is. Yeah. The risk of venture investing is so high, and technology sectors typically yield the highest returns. So I think that's why it's become so synonymous.
Now, at this conference, what were the answers, and was there anything surprising? I mean, what subsectors of technology are particularly hot?
Software, internet-based, some social networking, and clean tech, green tech were the ones that were highlighted as being areas that funds expected to be investing more and more in. The general trend suggested by the funds is that it's a very good time to be an entrepreneur. They're all looking for investments.
This recalls the 1990s, of course.
Hopefully smarter.
Hopefully. What's changed in the practice since the 90s?
Well, the 90s were a time of a bubble. And what we saw in the 90s going into the early 2000s, the bubble burst. It was much, much harder to get funded. The pendulum shifted much in favor of the folks with money to invest. What we're seeing now is that it's a very good time to be an entrepreneur. The benefits in a term sheet from an investor are much more towards the entrepreneur. An entrepreneur with a good company has a potential to call the shots in a term sheet. The
major issue coming out of a lot of surrounding tech companies these days are the way shares are being traded on secondary markets. What's to be made of this? Is there a story here? Is this going to be one of the new legal issues for venture capital?
The secondary market's been around a while, and it kind of flew under the radar in the very beginning. It was a way for funds to either unload interest they had in companies, or limited partners in funds to unload their investments in the funds. The startup itself, as a privately held company, is subject to strict SEC regulations on how the shares can be traded. So what we see more and more is a situation where, for example, a limited partner in a fund can't afford to make those capital calls that they're required to make for the fund. And so they will sell their investment in that fund on a secondary market. Or in another example, a fund maybe does not want to re-up into a company, or needs to generate some cash and wants to sell their equity in that company. It's done privately to stay within the SEC laws to keep those startup companies private.
Is this an area where we should expect to see Congress enact further regulation?
I don't know. I think if it becomes a very significant way to trade equity in startup companies, then I think yes. But right now, I think it's more focused on the fund side. And so I don't see it happening just yet.
It's not imminent. It's something that might be
I don't think so.
considered down the road.
It might be.
Mm-hmm. I asked you before about how the practice has changed in the 90s. Let's flip over to the business side. Is there a different look in your clients' eyes now than there was back then? I mean, we've been through a real tumultuous period, and I would imagine it takes a lot of gumption to start a business in this environment.
Absolutely. And it's the scrappy. I always tell them that they have to be scrappy to survive it. One of the things I'm seeing is my clients have gotten smarter in how they're spending the money they have. So money lasts a bit longer. There's less of a burn. And they've figured out how to stretch the dollar. It makes them smarter. It makes them more valuable when they go back to the fundraising market to raise money again. So I think they're smarter entrepreneurs. I think what we're seeing now, also as discussed on that panel that you mentioned, the funds are looking for deals. They have money to spend, and they're looking for deals. And so, you know, it's a good time for an entrepreneur to be out there hitting the market for money.
I wanted to ask you about fees. How does one charge a startup company for legal advice?
Very carefully.
Right.
Because the last thing that startup wants is to run up a big legal bill, and it's the last thing I want, because I never want to be the choice between rent or legal bills. What we try to do for the very early stage companies is to offer them flat fees on deals on clear deals, like, for example, an angel round or a Series A round. What we also do is provide a lot of forms, and the truth is, in the very early stages, there's not a whole lot of legal work that the early stage companies need. They need to be formed in the right way. They need some basic documents. We have a data room, like a website, which we give them access to, and they download the forms that they need. So we try to manage it that way. It helps on both ends. The last thing we want to do is run up a big legal bill on the very early stages.
All right, and finally, favorite success story. This has to be a cool part of working in the legal profession, because you get to see these companies start at nothing and hopefully grow into the next Twitter or Facebook or Google. Which one of the firms that you've worked with so far has been, you know, your favorite child, so to speak?
so I'll tell you a current one. I'm a co-founder in a company called Mojiva, which is a mobile advertising platform. And I've been with them clearly since the very beginning, because I helped cook up the idea. And it's wonderful to see where they are right now. They're doing very nicely, finished a Series B round, and they've got some very interesting things going on. They're based right here in New York.
Oh, great. Exciting stuff. Mojiva, you heard it here first. Lori, thanks so much for coming in. This was a pleasure.
Lee. It was great. Thank you.
All right. That's Lori Hoberman. She is a partner at the law firm Chadbourne Parke, based here in New York City. If you'd like to learn more about venture capital, go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Lee Pacchia. Thanks for watching.